Hey friends, my name is Sahil and this is my Personal Finance Academy. I remember having a conversation with my dad on interest rates on FD, and he said that there was a time when FDs used to give 10 to 12% fixed interest every year. And then in early 2000, FD rates went down to 9 to 10%. And since I have started investing, I have seen FD rates going down from 8 to 9% to currently at 5 to 6%. And remember that interest on FD is taxable as per the tax slab. So assuming that even if you get 6% interest rate and if you fall under 20% tax bracket, then your post-tax interest would be around 4.8%. And in case you fall under 30% tax bracket, then your post-tax interest rate would be around 4.2%. Now on an average, the inflation rate in India is around 5%. So basically your FD returns post-tax are even lower than inflation rate. It means if you keep your money in FD, then essentially your money is not growing. In fact, your money is actually shrinking. This has made FD a less attractive option. Sure, there is guaranteed return and might be useful for old age people who have a very low risk taking appetite. But certainly not a good option for young folks that are looking for better returns than FD and having a slightly higher risk appetite. Now you certainly have options like stocks and equity-based mutual funds that can generate high returns. But let's not forget that they are highly volatile where they can even give negative returns in the short term. So the question is there an alternative to FD that can generate higher returns than FD but at the same time not so volatile like stocks or equity-based mutual fund? Somewhere in between. So in this video, I want to discuss about an asset class called bonds that can give up to 9 to 10% fixed return. But it is less talked about and the majority of people have limited knowledge about bonds. So we will cover various topics related to bonds like what is bond, what is NCD, how to shortlist a right bond or NCD, then how to invest in bonds and NCD. In fact, just like your stock IPOs, even bonds have an IPO. So we will discuss more about the bond IPO as well. Then we will discuss the right strategy to invest in bonds. This strategy would be very useful for your investment in bonds and NCDs. Alright, let's get started. So every company needs capital to run the business. Sometimes it needs external capital for, let's say, acquisition or expansion plans. Then financial companies like NBFCs raise capital that they can lend as a loan to end consumer at a higher interest rate. Now they have two options to raise capital. Either by diluting their equity, that is by selling their shares, or by issuing bonds at fixed interest rate. For example, they can raise bond for rupees 100 crore at, let's say, 7% annual interest rate where they will give 7% fixed interest per year. So bond is type of loan that corporate houses take to run their business. Then you have something called NCDs, that is non-convertible debentures. These debentures are also fixed income instruments similar to bonds, but the key difference is that bonds are generally secured whereas NCDs are generally not secured against the asset. So if a company fails, then the bondholder will be paid first with the asset liquidation. So NCDs are relatively more riskier than bonds. But remember that NCDs offer higher interest than bonds. Then another difference is that if you want to invest in bonds, you need to invest a relatively high amount like rupees 2 lakh, 3 lakh. Whereas you can invest in NCD via the IPO with as low as rupees 10,000. I hope now you understand the difference between bond and NCD. We will discuss more about investment process but in the later part of the video. For now, let's first understand how to shortlist a right bond or NCD. To shortlist a right bond or NCD, the most important parameter is to check the creditworthiness of the company. It basically means what are the chances of investors getting their money back along with interest and what are the chances of company defaulting. For that, you can look at the rating of the company. So there are credit rating agencies like CRISIL, CARE, India Rating, etc. that give credit rating to companies based on their financial strength, payment history and many other parameters. For example, a company with AAA rating from CRISIL means highest safety. Then AA means high safety and very low credit risk. Then you have A, then BBB, then BB and so on. But as the rating falls, the default risk increases. Now a bond or NCD with AAA or AA rating would offer a relatively lower interest rate than a bond or NCD with, let's say, A or BBB or BB rating, because in finance you have a very simple concept: higher the risk, higher the return, and lower the risk, lower the return. But don't get too greedy with high returns, and always shortlist companies with top ratings like AAA or AA. Then another important parameter to shortlist a bond or NCD is the investment horizon. That is, how long is the maturity period of the bond. Bond with longer maturity offer higher interest rate. But as an investor, you need to identify what is the right duration for you to lock your money, and accordingly invest in bonds and NCDs. Now you might have a question that in the past, even good rated bonds have defaulted. So what is the guarantee that you will not lose your money? Now this is a valid point. In the past, there have been few cases where the companies with good ratings have defaulted. But it is not that every other top rated company would default. The probability of default from a top rated bond is very low. Yes, there can be exceptions as there is a certain level of risk. But that risk is everywhere. No investment is completely safe. At the end of the day, you need to understand your risk appetite and the kind of return you expect, and invest based as per your risk versus return appetite. But you can surely reduce your payment default risk from bonds and NCDs by using an investment strategy called laddering. That I will explain shortly. But for now, we'll look at the process to invest in bonds and NCDs. I was recently searching for a platform to invest in bonds and NCDs and came across GoldenPie platform that can help in investment in bonds and NCDs. So let me quickly show you how you can invest using this platform. To open the GoldenPie platform, all you need to do is Google this word GoldenPie and you can see the first link. Just click on this GoldenPie and you will see the home page of this GoldenPie platform. Now let's first try to identify how you can invest in bonds. So here you have an option of Discover Bond. Just click on this. Here you can see various bond options. So you have got the bond of South Indian Bank. Here you can see details like what is the minimum investment. Here you need to invest minimum of 2,24,863 rupees. Then yield, which is 13.72%. Then payment term is what is the frequency of your interest duration. So here it is yearly. Then you can see the rating is A minus. Now as we discussed, it is better to invest in bonds with AAA or AA rating. For example, you have Indiabull Housing Finance with minimum investment of 4,94,000, yield of 12.43%, and it has got a rating of AA. So it is much better. Then you have various other options and like your Muthoot FinCorp and all of this. Now interestingly, you have got a lot of filter options here. For example, what is the investment purpose? Let's say you want to identify bonds that can earn you higher fixed income than FD. So if you click on that, it will filter out all those bonds for you. Then you have got an option to identify bonds as per their credit rating. For example, let's say you only want to invest in bonds with, let's say, double or AAA rating. So if you click on AAA, you can see only those bonds with AAA rating. And then you have an option to filter out bond with yield. So for example, you have got yield up to 8%, 8 to 11% and like that. Then you have filter of investment amount. So you can invest in bond with less than 10 lakh, 10 to 50 and all of that. Then you have payment frequency and all of these. Now let's look at how you can invest in the NCD IPOs. Just click on this GoldenPie link and just scroll down. Here you can see the option to invest in current IPOs. So just click on see more. Here you can see all the NCD IPOs. So you have got the NCD IPO of Edelweiss that closes on 27 December. The minimum investment is just rupees 10,000. Yield is 9.7%. Payment is monthly. Tenure is 120 month, that is 10 year. And you can see the CRISIL rating. Here you again have the option to filter out all these NCDs, and you can see there are a lot of options. Now let's just click on one of the options. So here you have 120 month tenure and payment is monthly. Then you have an option to choose for again 120 month tenure but payment is yearly. And then you have got 60 month tenure where payment is cumulative, then 60 month with payment is monthly. So as per your tenure and as per your payment, your yield would vary. Now let's click on one of the IPO link. Let's click on this and you can see all the details like what is the minimum investment, it is 10,000, what is the yield, tenure, and what is the credit rating, what is the debt quality and all of that. You have a very interesting thing here. You can actually see the cash flow. So let's say your investment is 10,000 and you click on this. What is the interest you will get per month? So you will get an interest of rupees 77.5 every month. And by the end of this tenure, you will earn rupees 9,300 interest and total return would be 19,300. And let's say you want to invest 1 lakh and see the entire cash flow, then you can see when you invest 1 lakh, you will generate an interest of 775 rupee per month. And by the end of tenure, you will earn an interest of 93,000 at a yield of 9.7%. Right? And if you want to see what is the process to invest, it's very simple. You just need to select the IPO series, enter the Demat and UPI details, accept UPI payment mandate and get bond units in your Demat account. Now you might ask, how safe is Golden Pi or any such platform to invest in bonds and NCDs, right? So please note that when you invest in bonds or NCDs using a platform like Golden Pi, your bonds or NCDs would not be held by Golden Pi. It would be reflected in your Demat account. But at the same time, you can see the investment details on Golden Pi as well. So even if anything happens to the investment platform, your bond or NCD would be safe in the Demat account. Once the bond or NCD matures, you will automatically get the money back into the account on the date of maturity. Now investing in bonds and NCDs have two major types of risk. First is interest rate risk. It means the interest rate on the bond is dynamic. For example, let's say you invest in a bond with 10 years of maturity at around 8% interest. Now there can be a case where the interest rate rises and the similar bonds give, let's say, around 9% interest. But your money is locked at 8% interest. So you will lose out on additional 1% interest. Then second risk is liquidity risk. So if you invest in longer duration bonds or NCD, you end up locking your money for a longer duration. Now there is a very interesting strategy that you can use to reduce your liquidity risk and interest risk. It is called bond laddering. So bond laddering means spreading your investment in bonds with different maturities. For example, let's say you have 5 lakh to invest and you want to invest for the next 10 years. Now rather than investing the entire money in a single bond with 10 years of maturity, you can invest in various bonds with different maturities. Let's say 1 lakh in bond maturing in 3 years, 1 lakh in bond maturing in 4 years, and likewise 1 lakh in bond with maturity of 5 years, 6 years and 7 years. Please note that shorter duration bonds give lower interest. So let's say a 3-year bond gives around 6.5% return, 4-year bond gives 7% return, 5-year with 7.3%, 6-year bond with 7.8% and 7-year bond with 8.2% interest. In this case, your average bond yield would be 7.36%. Now after 3 years, when your first bond matures, you will get the money. This way, you can reinvest it again. This can continue every time some portion of your portfolio matures. Now what are the benefits of bond laddering? First, it will help you create a predictable stream of income and help you manage interest rate risk. So when your bond matures, at the time when interest rates are rising, you can reinvest that money at a higher yielding bond. However, if the interest rates are falling, you will get lower yield on reinvestment. But you already have longer duration bond earning you higher yield. Also, by spreading your maturity dates, your money won't be locked into a fixed bond for a fixed time. So this would give you the liquidity and choice whether you want to use the money on maturity or reinvest it. But remember that the time duration is very important here. If you need money in short term, then you can use a shorter bucket of 1 to 5 years. Then if you don't need cash in short term, then you can spread the ladder for, let's say, 3 to 10 years. This bond laddering is a very interesting concept but might be difficult for some of you to understand. So I would suggest watching the video again to get a good understanding of this concept. So in this video we discussed how fixed deposit return post-tax are not even able to beat the inflation and shrinking your money, and how bonds and NCDs can be an alternative for fixed deposit. Then we also discussed key points you need to keep in mind before shortlisting a bond or NCD. Always remember to check the creditworthiness of bond and NCDs and understand the risk and return aspect. And please do not blindly go for higher returns. Then we discussed about the Golden Pi platform and how you can invest in bonds and NCD IPOs with as low as rupees 10,000. Finally, we discussed the strategy of bond laddering to manage the interest rate risk and liquidity risk. I hope you will find this video useful. Let me know if you have any doubts, put it in the comment. I'll see you in the next video. Till then, take care.